Basically, what I do is I try to discover the story behind the data, gain information and knowledge that would help us to make a decision, like when to enter the market, when to exit the market, which are the best stocks to invest in.
How does the visual sectors model and method compare to other methods?
It cuts off the error and missed points significantly. One of the things that makes me very happy about this model is seriously a step forward in our efforts to understand the connection between options market and equity movements. But I don't think this is the end of the modeling efforts.
Yes.
I'm sure that the team will continue to build more models in order to be prepared for future.
Dr. Ali is a leading data scientist and econometrician who has developed complex data models. He's here to talk with us today about how these models are created, verified, and applied to real-world situations to create consistent returns. Hi, I'm Brian Tanok, Chief Data Analyst at Visual Sectors, a 20-year buy-side Wall Street analyst and data consulting expert. I'm joined here today with Dr. Ali Dadpe. How are you, Doctor?
Thank you so much, Brian. It's great to be here.
Today, we're going to talk about data. And whether you're a new investor or an old pro, you should know that data will drive all your trading decisions. Traders use data to identify their stock picks, identify entry and exit points, and manage their risk along the way. But when it comes to actually analyzing and integrating data into your trading strategy, there's a lot that goes on behind the scenes. Dr. Ali is a leading data scientist and econometrician who has developed complex data models. He's here to talk with us today about how these models are created, verified, and applied to real-world situations to create consistent returns. Dr. Ali, thank you for joining us.
Thank you for having me, Brian. How are you today?
I'm very well, thank you. And you?
Thank you so much. Lovely day in Houston.
Lovely day in Houston, that's right.
Yes.
So, Dr. Ali, can you please tell us a little bit about your work in the fields of econometrics and data science?
Basically, what I do is that I try to discover the story behind the data, highlight the trends, gain information and knowledge that would help us to make a decision, like when to enter the market, when to exit the market, which are the best stocks to invest in, which stocks are not good to invest in, and at the same time measure the performance of the models, maintain their consistency, and make sure they are robust enough to be applied to variable stocks and different markets. So one of the interesting things about this particular project is that it's tried to leap forward in financial research and equity studies to reach a point that we can use a model relying that it stays validated and consistent.
Okay, fantastic. How did you get started in this field?
Well, I like numbers and I always thought that it's numbers by them. You know, one of the things that is very attractive about numbers is that by themselves, numbers are boring.
Yes.
Nobody remember how many shirts Da Vinci bought. Everybody talks about Mona Lisa because, you know, that's the fascinating part. But when you look at the numbers and the story they tell you about the people, about the businesses, about the markets, about our life and as a society and our lives as individuals, it's just fascinating.
Yes.
And I really like it that I can discover and tell that story and tell it in a way that it stays consistent.
So it's almost like the numbers and the data are a universal language.
Yes. I mean, it is very interesting that how everybody everywhere use numbers to communicate.
Exactly.
Doesn't matter what mother language they have or what they speak. Numbers talk louder.
Exactly. Exactly. So can you maybe describe some of the studies that have been done previously prior to looking at the visual sectors model that explored the relationship between option data and stock returns?
Well, as you may know, because such a great portion of economic and business activities go into financial markets, there have been a large number of researchers trying to find out a way to forecast equity movements or stock movements,
Exactly.
You know, when the prices go up, when the prices go down. And one of the fascinating things about the financial market is that no single person has all the information. We all act at the same time using our own interpretation of available data and information. So we might even move in different directions. Let's say that today some people might be selling a stock that other people are looking to buy it based on their own interpretation of the future and the story they believe in.
Yes.
So when you look at the studies since 1980s, 1990s, people have been working on using and finding the variables and factors they can use to predict equity movements. But one of the biggest markets that start to give us that idea is the options market, because you see, option is not just about the equity, it's about also your knowledge of the risk. Like when you do you want to have priority over selling something or buying something, that is all based on your own perception. Now, this perception comes from experience, knowledge, studies, research, everything. Now, one of the great things that as we move forward is that researchers start taking notice of this market, option market, to predict equity movements, late 90s, early 2000s. And as we moved forward, they explored this field further and further. But there were two challenges. One, when you discuss the risks is not about the averages anymore. Risks about the worst case scenario and best case scenario.
The tails.
I mean, like we are on the 21st floor. If something happens, God forbid, and we fall from 21st floor, the worst case scenario is not something we want to contemplate.
Yes.
The best case scenario is that, it's going to say a beautiful day, nothing happens, and everything moves forward smoothly. It's a different risk situation than doing this on the first floor or ground floor. So you need to know the difference between uppers and lowers, the volatility part, the variance, the changes, the average changes, not the average points. So as we move forward toward that, a lot of researchers face this challenge of building a model that can be validated elsewhere, because a lot of times we have overfitting. Also, we are talking about financial markets, which is very fast to move. Pieces of information become available and people respond to them very quickly and rapidly. Like these days, thanks to the automated trading and machine learning, it's like in fraction of a second.
Exactly.
So what happens here is that you cannot apply the same testing procedures as you used to in other models. Like Dr. Hashim Prasaran of Cambridge, he has a paper that says that at 1% should be your cutoff.
Okay.
Usually it's 5 for other studies, but here we have a 1% cutoff, which means we have a lot more dedication to make it accurate, to have a large confidence interval and everything else.
So what is it about options data that's different from regular like market data in the equity market that allows us to gain these insights?
Okay, let's give you an example. We are in Houston.
Yes.
Is there a property here you really like?
In Houston?
Yeah.
I like the property we're in now.
Okay, no, let's say you have a dream property.
Okay.
And you cannot afford it today. And you expect that tomorrow the market gonna go up and this is gonna be 20%, 30% more expensive than today. And you come and say, I pay a fixed price today to be the priority buyer here based on the price today, 6 months from today. So that way you try to manage your risk.
Yes.
In order to not buy this more expensive than it is right now. At the same time, you might want to sell your property one day and you want to make sure that you don't lose your equity in it, you don't lose your savings in it. You reserve the right to sell it at a certain price.
Yes.
So that's what about options matter. Options exactly is about how much money you put down to protect yourself. It's like insurance in a way.
Exactly. Like
so
insurance.
like in Houston, based on the traffic, people are willing to pay a high premium for insurance because they know accidents happen a lot.
Yes.
But let's say you are out of Houston, you are in Huntsville, you are in somewhere else, you are like in Paris, Texas. Accidents don't happen that often. Your premium becomes more of a burden to you as a consumer. You don't want to pay such a high price for it. So one of the things we look at option market is to get that general appreciation and perspective of risk, because there are so many actors and everybody moves along.
Yes.
So we look at their decision as the signal of what they think about future.
And it's within a certain time for their time frames as well, correct? So we can look at the difference between a 6-month risk and a 1-year risk.
Or 5-year risk, or 30 days risk, or exactly what you say is right. Like, let's say you don't expect anything happen this holiday season. So you reserve your airline ticket when you usually reserve your airline ticket. But let's say like summer, we have a peak in the prices and you say, maybe it's gonna get more expensive. Let me call the airline, see if I can put a down payment on my tickets now and make sure I don't pay too much for them later.
Exactly.
That way you protect yourself.
Yes.
And that shows that what is your perspective of risk based on what we experienced in summer.
Exactly. So in your evaluation of the visual sectors models, how would you describe the process to, say, a layperson, to somebody who's not an expert investor or a mathematician?
So one of the great things about the models is that models are very good. I mean, generally, models are very good instruments to abstract the information into what we want. But often models are too rigid. They are not providing the same results when they used elsewhere. Like, let's say, credit score model. If we get the credit score model for Houston, probably we cannot apply it to Seattle.
Yes.
We cannot apply it at all to anyone outside the United States because this is our market.
Yes.
Both as an ecosystem of our business and economic lives, as well as our activities. So what a visual sector does is that they come and combine two sections. One is the quantitative, which researchers have been dealing with. One is qualitative, based on what we can find out there, interpretations, headlines, images, even the sound of the voice. Like, when you are very tired, if you call your loved ones, they hear that in your voice.
Yes.
It's a quality. They cannot say it was like fatigue level 5. It was just Brian was very tired. So one of the great things about visual sectors models is that combining this qualitative and quantitative in order to create a model that can be adjusted automatically to the environment itself, to the ecosystem itself, and stay valid and stay robust.
So dynamic at the same time.
Exactly. So look, for example, right now, the stock market's going up and down every day. Equities move. Housing prices go up, go down. You have all of those information. But you are in US economy, the largest economy in the world. Your property rights are well protected. All of these can be factored in.
Yes.
Now, grab the same model. Let's go to somewhere that is going through an economic crisis or a political crisis, and it's not US. So you have to factor in that environment. When people are quitting the market there, it's different from quitting the market here.
Yes.
And this model does that.
Okay. How does the visual sectors model and method and approach, how does it maybe compare to other methods and models that have been?
One of the things is that since I had the pleasure of working on the validation of this model across 20 years of data, I can tell you that it cuts off the error and missed points significantly. Like, it has only, compared to the existing models, this one has less than 25% of their error points. Because points, as you said, entry and exits. It's like I'm on which highway you hate most in Houston?
59.
59. I'm on 59. I miss my exit. And when I'm there and missing my exit, then it's a huge deal for me in that traffic to come back to it.
Yes.
So in the market is like that. When you miss your exit, it means you're going to lose. Your return on investment is not as much as you expected it's going to be. It's even might be negative. So it's very important to estimate those turning points and to forecast them accurately.
Okay.
This model does a great job on that.
Okay.
And compared to existing models, its performance is much higher.
Okay, fantastic. And can you maybe just explain a little bit more, when you use the term errors, are you talking about predictive errors? Or are you talking about trading errors? Or can you just expand us?
Well, trading is always an action.
Yes.
In my humble opinion is that you get, like what you said, you get the data, you get the information, you make a decision, either yourself as an individual or your algorithm to do a trade or not to do a trade. What we are talking about is predicted turning points. Like, I predict based on what I'm reading about Boeing raising $19 billion to cover its financial commitments
situation
and make sure that it goes through this transitionary time. And at the same time, I hear that some airlines are cutting their orders for Boeing. Then I might expect that Boeing is falling right now as a stock. But if this plan goes through based on the uniqueness of the Boeing and its market share, it bounces back. So then I take an action, either buy now and exit later, or stay with my shares and exit much, much later. So when you do that, you are predicting, you are forecasting your turning points.
Yes.
And based on that forecast, you make a decision to trade or not to trade.
Mm-hmm.
So it's not, trading gonna be the result of this model. And based on the performance, you can rely on it to give you good turning points.
Mm-hmm. So you have over 20 years of experience in data analytics,
Yes,
correct?
that's scary, isn't it?
It goes fast.
It does.
And you have over 28 publication credits under your belt. How do experts like you validate models? Can you talk about the validation process and what goes into that? And how do you go about validating a model like the visual sectors?
Often you look at the model. When I say you look at the model, I mean the whole model, estimated coefficients, parameters, and everything else.
Mm-hmm.
They have used data to build this model.
Yes.
And these coefficients are estimated based on that data. Now, if this model is a valid one, it has to perform close enough on a separate set of data. So again, here is one of the places that visual sectors actually outperforms others, because most of the researchers that have done this work either used the whole model, the whole data, to build their model, and then see what the data is telling them, that specific data. They didn't grab their model and try it elsewhere, so they don't know if this model is valid. Let's say they build a model for New York Stock Exchange, but we don't know if this model gonna have the same performance in London or in Paris. We don't know, okay? So as a result, some others come and cut their data, like, divide it randomly between 40%, 60%, 50-50, 30%, 70%, build a model on 70% or 60% of the data, then run it on the rest of the data. Still, that data divided, especially when you're talking about stock market, could be interconnected. So you actually, if your model is performing well on your data, when you validate it, it's still going to perform well. But it is because you're looking at the same time frame, you're looking at the same market location, everything else. Here, what we have done is that we grabbed the model and we used 20 years of data.
Yes.
To make sure that this model is performing above and beyond the time frame and the location. And it is doing a pretty good job.
So you're talking about in-sample testing versus out-of-sample testing. And the out-of-sample testing process is you say is robust for the...
Yes. Like, for example, let's say, again, because more people are familiar with this, I'm going to use the credit score example. One of the things is that two very different individuals can have this very same credit score. Why is that? Because those factors that determine that credit score are very similar between those two. Also, on appearances, they are very different from each other. So as a result, they have the same credit score. The same applies here. We grab this model with all of its parameters and everything else and applied it elsewhere. And we try to see that is it forecasting the turning points accurately? It does. How many it misses? Very few. And can we use it to make a decision? Can you give this model without me being part of the construction, and I start to use it for my trading? I can. This is a good model. It's a reliable one.
So Dr. Ali, in looking at models and building models, we look at parameters that might have predictive features that help the model perform better into the future.
Yes.
Can you tell us a little bit about what some of these parameters are on a basic level, and then how the visual sectors models uses certain parameters in order to have its predictive capability?
Since we are looking at the return on investments as indicators of our decision to enter or exit, and in this case would become return on equity in the market, the prices going up and down. And as you may know, most traders make their money from fluctuations in the stock prices. They don't make their money from dividends. They look at the price going up, they get ready to sell, capitalize their gain and save it, and then go back, buy lows, say high. Basically, that's the golden rule of the market here.
Exactly.
Now, the catch here is to use a technique to build a model that use the most information content. You see, I really like it when, for example, I'm a big fan of the detective stories.
I'm sorry, the detective stories?
Detective stories, like, Hercule Poirot or Sherlock Holmes. And one of the things that fascinated me as a teenager with Holmes' story was that how he can deduce and deduct so many conclusions from one simple observation.
Mm-hmm.
Now, to put it in modern terms, in financial market terms, is that you have one observation, but this observation comes to you from a large number of potential observations.
Yes.
So in building these models, we also have to ask ourselves, because we want this model to work elsewhere, what if we didn't have this observation, we had something else but from the same process?
Okay.
So one of the features of these models that we are using in visual sectors is that we use methodologies that enables us to maximize the information content and do a little bit of simulation, make sure that we also look at the things we haven't seen. So we use random forest, we use KNN, we look at mutual information, look at recursive feature elimination in order to create these models. So one of the good things about this is that it's not a simple line. I'm not looking at a very linear approach. We are looking at a non-linear approach because after all, financial market could be very non-linear place, and people might respond differently to different things. So we want to look at that and make sure that our model is ready to handle those changes and adjust itself to the variations and shifts in environment.
And that's where machine learning models and predictive AI models come into play, because they're
Absolutely.
able to perform those more robust calculations.
Not just
and
more
processes.
robust calculations, they can also perform and adjust themselves to the changes. Let's say we are looking at the buying equity in an air conditioning company, and this year was a very hot summer.
Yes.
Significantly hot summer. So that means that air conditioning business is going to be good in future. We need a model who we can feed that to, and that model adjusts itself. Because you see, like any other decision making, consumers, that revenue for all of the businesses come from consumers at the end buying their products and services, rely on their budgets and how significantly they need something or want something.
Yes.
As a result, it's good to have a model that can take in the business ecosystem as well.
Okay, very good. So we talk a lot about the numbers and the quantitative data, and I think that's pretty easy to wrap our heads around. But perhaps what's maybe a little bit more difficult to understand from a wider perspective, just a general perspective of modeling, is how is qualitative data integrated into models? How do models use qualitative data, something that might not be so hard and rigid?
That's actually the part that this model succeeds, is integrating the two parts, because qualitative data is not something we can quantify.
Exactly.
I mean, like you and I both look happy right now, but can I assign a number to your happiness and compare it with my happiness? Not really, because every person feeling about his or her own happiness is very individual. It is not quantifiable, but we can categorize it. Like we can put both of us in the happy category without trying to compare two happy people. Then might someone just run lottery and run through this corridor and yell, I won, I won, I won. That's like, extremely happy person. It's going to be a different category. Great thing about this model is that it takes that into account.
Okay.
Like, are you confident about your future? Okay, good. You are financially confident. You are financially secure. You shouldn't be worried about the stock market today then.
Yes.
Are you confident about the future of the stock market? Is it somewhere you want to put your savings in order to have a good retirement? Now, that's a different question. There are people who are confident. There are people who are never confident. And there are people who look at the environment, the economic growth, the different parameters and factors, and they say, I am like somehow confident. I like gonna put 50% of my savings into this market. Now, when that happens, you need to ask yourself that, okay, is my model seeing these things? Is my model seeing that the number of people having confidence in the future of the financial market changes? Can it see that there are categories of investors, people who never invest in the market, people who invest small shares of their savings in the market, people who are very confident about the future and do it, and there are people who make money from trading always. So this model is good because it takes that into account.
Okay.
In other words, it also checks the sentiment of the investors and traders.
Okay. So once a model has identified all the appropriate parameters that it wants to use to analyze data, how does it identify which parameters are more important than the others? How does it map out the statistical relationships that build the model?
So that's again, it's a very important part because, first of all, a statistical correlation doesn't mean causality. You have to have a theory, you have to have a story in order to think something gonna affect something else.
Yes.
The change in this variable changes the other variable. So one of the things that we look at always is the share. How much this variable can explain changes in this other variable. So in this case, I'm looking at the option market, and I want to estimate and understand the volatility and variance and the ups and downs in the equity market.
Yes.
How much of that variance is explained by variance or parameters in this market?
In the option market.
Exactly, in the option market. I choose my variables based on that. Then also, I not only look at the statistical significance, I look at the economic story. I look at what does it mean. Like, let's say, one of the things we have witnessed in past decades is that a large number of people or an increasing number of people gonna rely on IRA, 401ks, different saving accounts in order to fund their life during their retirement. Because they are increasing, reliance on financial market or equity market is increasing.
Yes.
As a result, the risk in the equity market or stock exchange matters to a larger number of people than before. Thus, the models has to perform much, much better.
Okay.
You're not talking about someone who, if misses, it's gonna be like 1% of the society. If we miss the turning points in the market, hundreds of thousands might suffer.
So the stakes are higher.
The stakes are much, much higher.
Okay, because the shape that the market's taken.
And the share it has in our daily lives.
Yes. So can you explain to our audience what parametric modeling is versus non-parametric modeling is, and maybe talk about the differences and how they work together?
Well, parametric models are usually models that you have an underlying data about which you have assumptions. Like, for example, if I'm using a model to see how many burgers I'm gonna sell, the average income of people matters to me.
Yes.
Now, the average income often comes from something we call normal distribution. It has assumptions behind it. It's parametric. And of course, because we have these assumptions, we can use specific techniques in order to estimate the relationship, to quantify the relationship between a variable such as average income and how much money you spend on lunch or how much money you spend on buying burgers. Okay. However, non-parametrics easier from assumption side. You say, I don't have any assumption.
Okay.
Very little assumption or few assumptions. In order to stay loyal to the data without limiting the information content of the data with an assumption of distribution, with assumption of where it comes from. Okay, so that way I look at, let's sentiment, like, people want to buy a burger today because it's a sunny day. The catch is on the other side, because you don't have those initial assumptions. This is going to be a more complex model to build and sometimes more difficult to validate. And in order to interpret the results, you need to understand your data very well, and there you need to use like something like information indexes or things that captures it in a way that doesn't need those initial assumptions. We go with parametric models often because first, assumptions can be valid in many cases, and they are easier to interpret and make a decision based on the interpretation. But the financial market, especially since behavioral finance is becoming more important almost daily,
Yes.
are moving toward a non-parametric approach because they want to capture everything that can affect you or affect someone's decision to invest in a business in order to explain the changes in the market. But with that, we have a more complex challenge of explaining and interpreting the results.
Mm-hmm. So moving towards models with fewer assumptions is the trend.
Yes.
Okay. So,
and if I may say so,
yes,
that means that before they would have assumed you and I as investors are the same.
mm-hmm.
The only a limited number of factors that they could observe or record affect our decisions to invest or buy equity or enter the market or be in the options market. Today, they say that that assumption is wrong because there are things affecting Ali that are different from things affecting Brian.
Mm-hmm.
And those are the non-parametric ones. Like you
Okay.
say, one day you feel good and you put $2,000 into a new business.
Mm-hmm.
It is not a decision I can explain with the expected return on investment or expected growth or anything else. It's just your feeling. And I didn't see that. I didn't know that.
Mm-hmm.
At the same time, you on another day can refuse to invest in such an endeavor because you don't have that good feeling anymore.
Mm-hmm.
And that means that, okay, so what should I do? It's the same person even. One day he did that, the other day he didn't do that. And all of the things I was observing about him are the same between these 2 points in time.
Yes.
So what changed? And then we used non-parametric approach.
Okay.
Okay.
So after analyzing the visual sectors model, what are your conclusions about the methods used and their abilities to identify stock option relationships?
Well, usually we look at a benchmark, often risk-free asset benchmarks that there is no risk here and we have risk here. So compared to that, how we are performing. Their model is very good when you compare those risk to risk-free models.
Mm-hmm.
They reduce the risk significantly.
Mm-hmm.
That's one. They also have very good predictive ability, or let's say they have a large win rate.
Mm-hmm.
Like if you choose 25 different businesses based on their model to get in, you can win on 24 of them.
Mm-hmm. Mm-hmm.
This is a, let's say, example to describe or demonstrate the situation.
The win rate, how often the model is correct.
Yes, it has a very good predictive ability. It has a high win rate. Hypothetically, I'm saying that hypothetically. So don't go choose these 25 different companies and invest in them. And if you don't win in 24 of them, come and call me. No, don't do that. But usually if you choose that, you can win in a large number of your equities and the loss is going to be very small based on this model. But like any other model, as I said, this example I used was to demonstrate how it performs, and based on my experience with validation, it performs very well. Also, it performs very well in learning and test samples. Like when you do the model because it's a ML model, and it has to do a good job learning also. It's not just you do the data, and it's not like before that the models are just getting one set of data and that's it.
Yeah. So when you say ML, you mean machine learning?
Machine learning, yes. Sorry. It's a machine learning model. The machine learning section does a very good job. And when you look at the test samples from various markets, it performs very well. So one of the things that makes me very happy about this model is it's seriously a step forward in our efforts to understand the connection between options market and equity movements. And it connects them not just through the traditional parametric modeling, but also through machine learning and non-parametric approach.
Okay, fantastic. One last question. When we look at the broader markets right now, and we were talking about the added risk and the added stakes that are involved in the markets right now. So if we look at the broader equity market right now, we see that we're at historic levels, obviously in terms of prices, but also valuations. We're seeing price to earnings ratios as around 30. Price to book ratio is over 5, higher than it was before the dot-com burst. We're actually seeing a lot of these different valuations. Inflation adjusted price earnings is at 37. All of these levels are nearing levels that we've seen, that were last seen pre.com. So when we think about models now and how models are using this type of information, say a model that's looking at fundamental data to predict whether the market is fairly priced, overpriced, underpriced, or how it's going to likely to perform in the future. At what point do models say markets are now behaving differently than they have in the past, and these higher valuation metrics are maybe more acceptable, whereas in previous times or in the past, maybe the models would have raised a red flag, or are they still raising a red flag and saying this market is dangerous, it's overvalued, or do they adjust? Do models adjust?
We're never going to have a market that is not dangerous, because you never have a risk level that is zero. I mean, people thought that about housing market, and back in 2007, we all had a very rude awakening about that,
Yes.
That was a wrong assumption. So let me rephrase your question. You're asking me that if, based on the historical past or historical trends, can we rely on these models to tell us or raise the red flags about upcoming crisis or financial turmoil? I think these models have a better chance of doing that. Because they use a much wider spectrum of data. They have the non-parametric set, they have the sentiments, they can assign weights to different observations, and they look at different activities in the market and interpret them. That's one thing. The other part is that yes, we have a higher valuation than past, but that's because we are a much bigger economy than past. Just compare what you buy for the Christmas presents these days, compare to what you receive as a Christmas present when you were a kid. I'm not saying that, poor us that, we didn't get iPads. Well, iPads were not available. They were not invented at that time. But at the same time, we have a much larger economy. We have both in the size and number of products and services in it. It's much, much larger than what it used to be. And it's also a much bigger economy. If you get on Amazon, you can, or eBay, you can order items from all over the world. That means you can wake up in New Zealand and have access to the markets in Canada and United States or England or France online. So we have a much larger market from that perspective. It's both good and it's scary at the same time, because it's good, it means bigger market, more opportunities for everybody. It's scary because the volatility in it can spread around much faster and much quicker than before, as we saw in 2007, 2008.
And as you said, it will affect much more people.
And affecting much more people. So I think the models that are trying to forecast turning points gonna stay a challenge for all of us. Visual sectors have done a great job of taking a big step forward in building a very reliable model, but I don't think this is the end of the modeling efforts. I'm sure that the team will continue to build more models in order to be prepared for future. And as we move forward, we can imagine more scenarios. I mean, in 2019, in January 2019, nobody would have thought that we would have pandemic by January 2020, but we had, and that changed our economy, our society. And it wasn't something that I was taking into account when looking at it. But today, I bet everybody is taking potential natural disasters into account, global pandemics into account, and all sorts of that when it comes to financial markets.
Okay, very good. Dr. Ali, thank you very much.
Thank you for having me, Brian. It was a pleasure.
Absolutely.
Thank you.